So you've heard about trading. It sounds exciting, maybe a little complicated, but definitely full of potential. Let's break it down into something super simple. At its core, trading is just the act of buying and selling things with the goal of making a profit. Think of it like flipping a house, but instead of dealing with contractors and open houses, you're dealing with financial assets like stocks or cryptocurrencies. You buy something when you think its price is low, and you sell it when you believe the price has gone up. The difference between your buying price and your selling price, minus any fees, is your profit. Now, not all traders operate on the same timeline. First up is day trading. This is the fast lane. Day traders buy and sell assets within the same day, sometimes holding a position for just minutes or hours. Then we have swing trading. This is a bit more relaxed. Swing traders hold on to their assets for more than a day, but usually less than a few weeks or months. It's a popular middle ground for those who have a day job but still want to be actively involved in managing their investments. Finally, there's long-term investing. This is the classic strategy championed by investors like Warren Buffett. It's less about timing the market and more about time in the market, letting your investments grow and compound over a long period. All right, before you can place a trade, you need to know what you're trading and how to actually do it. Let's start with the playgrounds where all this action happens, the financial markets. First, the stock market, where you buy and sell shares, which are tiny pieces of ownership in public companies like Apple or Tesla. Then there's Forex, short for foreign exchange. This is the market for trading currencies, like betting that the euro will get stronger against the US dollar. Next is crypto, the new kid on the block, involving digital currencies like Bitcoin and Ethereum. And finally, we have commodities, which are raw materials like gold, oil, or even coffee. Choosing a market can feel overwhelming, so here's my advice for a beginner. Start with what you understand or find interesting. The key is to pick one, just one, to focus on initially. Don't try to trade everything at once. Once you've picked a market, you need a way to access it. That's where a broker or a trading platform comes in. And listen, this part is incredibly important. You absolutely must choose a regulated and safe platform. For stocks, you might look at brokers like Fidelity or Charles Schwab. For Forex, platforms like IG or Oanda are well regarded. And for crypto, using established exchanges like Coinbase or Kraken is much safer. A market order is the simplest. You're telling your broker to buy or sell an asset immediately at the best available current price. A limit order, on the other hand, gives you that control. You set a specific price, and the order will only execute if the market reaches that price or better. Before you even think about putting a single dollar of your real hard-earned money on the line, there is one step you absolutely cannot skip. I'm talking about opening a demo account. Seriously, do not skip this. Think of it like a flight simulator for a pilot. You wouldn't want a pilot's first time flying a real plane to be with actual passengers on board, right? It gives you a big pile of fake money, say $100,000, and lets you trade in the real live markets without any of the real live risk. It is the single best way to learn the ropes. It's an invaluable, pressure-free learning environment. You should spend a decent amount of time here, at least a few weeks, maybe even a month or two. The goal isn't to become a fake money millionaire. The goal is to build consistency and confidence. Treat the fake money as if it were real. Practice with the same discipline you intend to use with your actual capital. The first thing you'll see is a chart, and honestly, it might look like a crazy, confusing mess of lines and colored bars. Don't worry, we can simplify this. Each candlestick tells you a story about what the price did over a specific period or time frame, like 1 minute, 1 hour, or 1 day. A green candle typically means the price closed higher than it opened, a win for the buyers. A red candle means the price closed lower, a win for the sellers. One of the most basic and useful is the moving average, or MA. It smooths out the price data to show you the overall trend direction. The Relative Strength Index, or RSI, measures the speed and change of price movements. A reading above 70 is considered overbought, below 30 is oversold. The MACD consists of 2 lines and a histogram. When the MACD line crosses above the signal line, it's often seen as a bullish signal. The key here is not to rely on any single indicator. Instead, you want to look for confirmation, where multiple indicators are all telling you the same story. You've practiced in a demo account, you can read a basic chart, and now you're ready to make your first trade with real money. Hold on. Before you click that buy button, you need a trading plan. Trading without a plan is just gambling. A stop loss is an order you place with your broker to automatically sell your asset if it reaches a certain price, limiting your potential loss. This is a take-profit order, which automatically sells your asset when it hits your target price, locking in your profits. When you do start, and I can't stress this enough, start small. Use an amount of money that you would be completely okay with losing. Starting small reduces the emotional pressure. Your goal at the beginning is not to get rich. It's to survive and learn. Finally, keep a trading journal. Every single professional trader does this. By reviewing your trades, you can see what works and what doesn't. You'll identify your mistakes and learn from them. Trading is a journey of continuous learning. Be patient with yourself, stay disciplined, keep learning from your wins and your losses, and you'll be on the right path to becoming a successful trader.